All right, good morning, and my name is Victor Castaneda.
Good morning, everyone. My name is Laksha Eri.
Good morning, my name is Henry Ruiz.
Good morning, I'm Gasia Sodorian.
Hi, I'm Sher Singh.
And judges, if you do the same.
My name's Alex Holbrecht. I'm the Executive Director of the Eastern Economic Association, and I was participating in the High School Fed Challenge in 1996.
Good morning. I'm Roy Webb. I'm a senior economist with the Federal Reserve Bank of Richmond.
Hi, I'm Stacy Tevlin. I'm the Chief of Macroeconomic Analysis here at the board, and this is my first time, so I'm enjoying this very much.
When you're ready, just let me know. I'll start the clock, and I have a 2-minute warning and a please finish warning when you get to 20 minutes, all right?
Okay, so just start and...
Ready?
Okay, we're ready.
Okay, I'll start the clock.
All right.
Go.
Good morning, and welcome to your favorite monetary policy talk show, FedWatch. I'm your host, Wall Street Journal columnist, John Hilsenrath, and today I'm joined by Federal Reserve District Bank presidents, Mr. Niana Kocher-Lakota of Minneapolis, Sandra Pinalto of Cleveland, Charles Evans of Chicago, and Mr. Richard Fisher of Dallas. Our guests are known to have divergent views on the economy, and therefore we should all be looking forward to a lively discussion today. The presidents have asked me to remind you that the views presented here are their own and not necessarily those of the Federal Reserve System. In its latest meeting, the FOMC decided to implement a second round of large-scale asset purchases, or as others have called it, QE2. Since the minutes have just been released, let's discuss a bit more on what took place at the November meeting. Could you characterize the economic conditions that led to this decision?
Hey, good morning, John, and I'm glad to share with the public what was discussed at our latest FOMC meeting. You're right, the economic recovery, which began in the summer of 2009, has lost some momentum in recent months. GDP for the third quarter expanded only at a modest 2.5%, which is quite a slowdown from the 5% experienced in the fourth quarter of last year. The increases we have seen are mainly due to upturns in personal consumption expenditures and investment. The increase in consumption is particularly important since, after all, consumption does account for more than 2/3 of domestic output. Disposable income has also increased, allowing consumers to slowly start spending again. For example, retail sales have rebounded from the low levels seen last year, and in fact, we have seen a rise for 4 consecutive months now. But it is worth mentioning that their retail sales remain sluggish as consumers are facing a tough job market and depressed home values. And ultimately, because of that, consumers are largely limiting their purchases to necessities and non-discretionary items.
And I agree, and this lack of discretionary spending is not positive for the business sector. As an example, manufacturing, which was a leading sector of the recovery, has slowed down in recent months. This is a concern for us since manufacturing tends to be highly sensitive to cyclical changes and thus a good barometer of overall economic activity. Also, the ISM index has remained in positive territory despite a recent slowdown, indicating an expanding manufacturing sector. Non-residential fixed investment has rebounded from the low levels that we saw last year, with strong increases in purchases of software and equipment. This can only indicate that businesses are gaining confidence once again. Nonetheless, growth in the business sector will be limited as long as consumption remains constrained by a weak labor market.
And speaking of the labor market, I think it's worth mentioning that this recession has caused the greatest amount of job losses since the Great Depression. In fact, it has been 3 years since this recession started, and yet we're nowhere near recovering the jobs lost. In fact, as the Bureau of Labor Statistics shows, there are currently 5 unemployed workers per job opening.
You make a critical point, John. Even though the unemployment rate has fallen from its peak observed in October 2009, it remains stubbornly high at 9.6% a year later. Moreover, the U6 number, an alternative measure of labor resource underutilization, is almost twice as high. The number of people working part-time for economic reasons reached its highest value since 1955, when the series was first tracked. Even though private payrolls have continued to expand since the beginning of the year, and the most recent employment report was encouraging, we are still a very long way from recovering the more than 8 million jobs lost during the recession. Another major concern is the length of time that individuals have been unemployed. The number of people unemployed for 27 weeks and over reached a post-World War II high in May and has remained unprecedentedly high since.
Yes, and in addition to the weak labor market, housing still remains a major concern. Although mortgage rates are at historic lows, new and existing home sales remain at depressed levels. Housing starts also below low levels we saw in June of last year, with the number of new permits issued signaling little improvement in new home building. Bigger concern for the industry, I would say, is the alarming rate of residential foreclosures and its economic and psychological impacts. Currently, more than 20% of borrowers owe more than their home is worth, putting them at risk, of course, should house prices decline much further. With the housing market still weak, high levels of mortgage distress may well persist for some time to come. On the commercial side, commercial real estate prices have continued to decline, with prices now at 2002 levels. Nonetheless, the news for real estate is not all bad. Broad measures of residential home prices have signaled that a bottom may have been reached, which is a necessary precondition for a recovery in this sector.
To take that a bit further, President Pinalto, I think we could agree that this recession was triggered by the downfall of the housing sector, or more specifically by losses tied to subprime mortgages. But as Chairman Bernanke has mentioned, it was really the structural weaknesses in the financial system, such as the overdependence on unstable short-term funding, deficiencies in risk management practices, and the excessive leverage in the shadow banking system that really amplified the initial shocks. This eventually led to significant instability in the financial sector. What are conditions like today in this critical part of the economy?
Well, conditions in financial markets have improved considerably since the height of the crisis in September 2008. Interbank short-term credit spreads have narrowed and returned to pre-crisis levels. Long-term interest rates faced by private borrowers have continued to decline as well. All of this was made possible by the swift actions of the Fed, first by lowering the target federal funds rate practically to zero by December of 2008, and then by more than doubling the size of its balance sheet. The Fed's response to the crisis can be categorized into three different time periods. First, the Fed extended its role as lender of last resort by creating new tools in order to ensure that healthy financial institutions had access to sufficient short-term credit. Second, the Fed started providing liquidity to key credit markets when it initiated programs that targeted specific credit markets that were still facing problems. And lastly, the Fed embarked on what is termed as quantitative easing when it initiated programs aimed at improving conditions in private credit markets by buying up to $1.725 trillion of agency debt, mortgage-backed, and long-term treasury securities.
Speaking of quantitative easing, the new round of large-scale asset purchases announced in the November meeting are projected to increase the size of the Federal Reserve's balance sheet to almost $3 trillion by June of next year. Isn't this potentially inflationary?
Yeah, John, there is always certainly a potential for inflation in the long run, but currently both headline and core inflation have remained subdued, and the rate of inflation is trending downward. This is not surprising given the significant resource lack in the economy. Inflation appears to be running at levels judged to be below those consistent with achieving the Fed's dual mandate. Also, given the trend of disinflation observed, there is concern of potential deflation, which could be disastrous to the budget recovery should this cause consumers to delay their spending. Despite all these concerns, inflation expectations appear to be well anchored, as indicated by current surveys of households.
In the minutes released this past week, each of you, as well as other FOMC members, submitted your forecast for future output growth, unemployment, and inflation for the next 4 years. Relative to previous projections, participants have revised their outlook for future growth downward and expect the decline in unemployment to be gradual. What exactly prompted the committee to revise their projections?
John, I think we all agree that forecasting GDP growth is difficult due to the uncertainties and risks that persist in today's recovery. But forecasts for overall output growth are somewhat encouraging, ranging from 2.2% in the fourth quarter to 3.3% by 2011. Earlier in the year, expansionary fiscal policies and a powerful inventory cycle fueled a significant pickup in growth, but neither is expected to contribute much to future growth. A weakening dollar and rebounding foreign economies should continue to stimulate exports. A falling dollar coupled with inflation abroad should reduce imports, dampening this drag to growth. But in order for sustained economic expansion to take hold, growth in consumer spending and business fixed investment must take the lead. But at this point, consumers are cautious, and the current high household saving rate reflects both the uncertainty in the labor market and the deliberate efforts to repair household balance sheets. Turning to the business sector, inventory levels have become better aligned with sales, and investment in equipment and software have rebounded from their lows seen last year. Also, new orders for capital goods, a leading indicator of future investment and manufacturing activity, is signaling a potential rebound in business fixed investment. But there are still risks that could further hamper both consumer spending and business investment, which will nonetheless remain constrained until we see an improvement in the labor market.
Well, I agree that unemployment does remain high, but the latest claims for unemployment insurance have trended downward. Also, the small decline in the unemployment rate can be attributable more to reduced labor force participation than to job creation. When forecasting future unemployment trends, it's essential to consider the impact that structural unemployment might have. The recent increases in job openings in the face of an unemployment rate that is not declining is suggestive of structural unemployment. Forecasts for unemployment are quite difficult given the amount of uncertainty in the economy, as can be seen by the difference in current forecasts. Nonetheless, I expect unemployment rate to be around 9.1% by the end of next year.
Right, and this current high level of resource lack will continue to put downward pressure on consumer prices. Longer-term inflation expectations remain stable, therefore inflation is likely to remain subdued for some time. Data indicates that future core inflation numbers will continue to fluctuate around 1.5%. Nonetheless, there is a risk that producers will pass on price increases onto their consumers since producer prices have been rising at a faster rate than consumer prices, and employment costs are now rising at a faster rate than in previous quarters. Additionally, the recent increases in commodity prices, particularly the price of oil, may contribute to higher inflation in the future.
We know from your recent speeches that each of you has different views on how the Fed should address the stagnant economy. The FOMC already began its large-scale asset purchases, and some argue that this is only going to continue to add to the amount of excess reserves being held at commercial banks. Could you discuss a bit more why the FOMC decided to go with this policy action?
Sure, John. First of all, we're experiencing significant high levels of resource lack in the economy. This can be seen by the ratio of actual to potential GDP, which is a historic low. This is of great concern to us, of course, since part of our dual mandate is to maintain the economy near full employment. And furthermore, the slack in the economy and the fall in aggregate demand that accompanies it tend to put downward pressure on overall prices and the rate of inflation. Nominal interest rates are low, so any further declines in inflation will cause real interest rates to rise. And in effect, this would represent a contractionary monetary policy, which is exactly the opposite of what the economy needs at this time.
Right, and so our decision to execute additional purchases of long-term treasuries is based on the assumption that these purchases will further flatten the yield curve. According to some estimates, the effect of previous purchases of longer-term interest rates are in the range of 30 to 100 basis points reductions. A new round of asset purchases should further reduce yields on longer-term treasuries, although today yields remain volatile and have risen somewhat since Chairman Bernanke signaled the possibility of additional easing in his Jackson Hole speech this past August. The importance of lowering longer-term interest rates is that these are the rates that determine future bank lending. So in effect, we would expect consumers and businesses borrowing costs to be lower and aggregate demand to be stimulated.
To elaborate a bit on what my colleague just said, let me explain how large-scale asset purchases affect and theoretically stimulate the economy. The primary channel is by reducing risk premiums. When the Fed purchases treasuries, private investors are displaced and are forced to buy similar assets, such as AAA corporate debt. When prices on these securities are bid up, their yields are lowered. This is commonly known as the portfolio balance effect. After the first round of large-scale asset purchases, risk premia fell sharply, but reached a bottom around the second quarter of 2010 and have risen since. The second round of asset purchases will be implemented to prevent risk premia from rising any further and to lower overall interest rates. Lower interest rates should encourage borrowing, capital formation by businesses, and consumer durable purchases by households. In addition, higher asset values will provide a direct stimulus to spending through the wealth effect on consumption and will improve the creditworthiness of both firms and households who seek bank loans.
As stated in your press release, the reasons for these additional asset purchases were based on the weak economy and the current risks of deflation. But in a dissenting vote, President Honig voiced some concerns about the policy decision taken in November. President Fisher, you have voiced some similar concerns. Could you perhaps elaborate a bit more on these for us today?
Sure, and I'm really glad you asked, Sean, because you always want to weigh the benefits and costs of any policy action. The benefits are unproven, and we still don't know whether the first round of quantitative easing worked or no. Another reason why I remain skeptical about expanding the size of our balance sheet with additional asset purchases is that it is still unclear what this will do to inflation and the public's expectation of future inflation. Over the past 20 years, the Fed has worked very hard to gain its credibility as an inflation fighter. What will happen if inflation suddenly rises to 3, 4, or even 5%, as some of my colleagues seem to prefer? My worry is that this may cause inflationary expectations to become unanchored, which would undo all the hard work done by the committee and also be inconsistent with its long-term mandate of price stability.
I think that some of the inflation concerns raised recently are somewhat misguided, at least in the immediate term. Much of the liquidity added by the Federal Reserve is being held in bank reserves. So adding to this amount of reserves is not likely to rapidly increase the rate of inflation. The Fed's asset buying gives banks new licenses to create money, but I don't see why they'd suddenly start to use the new ones if they weren't already using the old ones. However, I don't see QE2 having much of an effect reducing the term premium between longer-term and shorter-term securities. But since we can't cut the federal funds rate any lower, I express support for QE2 due to the especially low rates of inflation and the sluggish recovery.
So obviously, there remain divergent views on the efficacy of these large-scale asset purchases. There are other many topics that we could discuss, but in the interest of time, let's conclude with one final question for our guest. What would be your recommendation for monetary policy going forward?
Well, after the last meeting's decision, John, I think we need to be forward-looking and consider the fact that the economy is growing, albeit at a slower pace than we would want to. Low interest rates mean negligible saving rate for households, and not all of them are sophisticated enough to search for riskier investments to save for retirement. Moreover, uncertainties in fiscal policy and not interest rates are the most pressing concern that businesses have today. So going forward, I think we should start to normalize policy by raising rates from the current exceptionally low levels, as can be seen by the recent application of Taylor rule. John Taylor himself believes that the federal funds rate should be somewhere around 75 basis points. This would also help the committee not repeat the policy patterns it adopted after the 2001 recession, when from fear of weak recovery, it left rates too low for too long, which caused the housing bubble, and something which we are recovering from very slow right now.
It might be wise for the public to revise its expectations of policy effectiveness. I'm primarily concerned that much of the unemployment seen in today's economy is that of the structural variety. That is, either job seekers do not have the skills sought by potential employers, or that job openings are in places where job seekers are not concentrated. Monetary policy cannot address this issue. Additionally, I think that a compelling case can be made for the Fed to institute an inflation targeting regime, with perhaps an even higher desired rate of inflation, say 3%. Such a regime would reduce uncertainty as to the Fed's objectives and should push up inflation expectations, reducing the real rate of interest, which is conducive to growth in the current economic situation.
Right, my colleague presents one view, but there are other policy actions worth considering, like price level targeting. Some skeptics argue that price level targeting could lead to inflation in the future, but the Fed has the tools to address these concerns. I would remind you that we're currently paying interest on required and excess reserves, and that we have a term deposit facility. Both of these tools would tie up reserves, and those allow the Fed to address any threat of inflation. And even if our actions were to cause some inflation in the near term, the consequences of not acting will be far worse, as this might lead us into a deflationary spiral. So therefore, I believe that the policy action taken by the FOMC on November 3rd was warranted, and that we have the tools to stimulate the economy.
Yes, unfortunately, we're not seeing a strong recovery after emerging from the longest and deepest recession since World War II. And progress toward meeting our dual mandate has been disappointingly slow. The unemployment rate remains elevated, and measures of underlying inflation are somewhat lower than what would be judged to be consistent with our mandate. Also, it seems that we cannot expect much support from fiscal policy in the immediate future, which means that the only source of stimulus has to come from monetary policy. I do not disagree with President Fisher that the Taylor rule is a useful guide to monetary policy. However, according to my calculations, given current economic conditions, the target federal funds rate should be slightly negative. And since current short-term rates are already at their lower bound of zero, an appropriate course for monetary policy in this case would be to target medium to long-term Treasury rates by being willing to expand the size of the balance sheet until we see consistent improvement in economic conditions.
Well, unfortunately, we have run out of time, but thank you for joining us today. And to our viewers, we'll see you again next week. Thank you.
Well, thank you. We appreciate your time and effort that went into this presentation, especially since it's near the end of the semester and a lot of things are going on right now. Let me begin by asking about inflation expectations. You mentioned that at a couple of points in the talk. Numerically, what are inflation expectations right now?
Numerically?
Yeah, can you put a number on inflation expectations right now?
All right, well, there's different, based on perhaps we would use not the household survey, but the TIPS survey. Currently, the TIPS are showing inflation expectations around what, 2.5%?
Okay, what time horizon are you looking at there?
This is the five-year horizon.
Okay, do you have any shorter-term measures you can look at?
Yes.
Right, the University of Michigan conducts a household survey of 1 year inflation of inflation 1 year from now, and that's currently at 2.7%.
Okay, that's a lot higher than inflation rates have been recently. Do you have an explanation for that?
So there are different ways to think about inflation expectations, and one way I think of it in terms of explaining why inflationary expectations currently are above the rates that we have observed recently, is that inflationary expectations present sort of this inertia, which is what has been observed in previous time periods is sort of what it's expected to be going forward, as opposed to perhaps more future forward-looking inflationary expectations, which are based perhaps on the policy stance and things of that matter.
Okay, so would it be fair to say then, since expectations are inertial, you would recommend the Fed not pay too much attention to them?
Okay. Well, no, inflationary expectations are important because after all, expectations of policy are a very critical component of formulating policy effectively. The problem is just that it's really inherently difficult to get a true, accurate measure of inflationary expectations. There are biases in some of these indicators. The TIPS market is it's a very small market compared to perhaps the treasuries, regular treasuries. So the additional liquidity premium sort of skews the measure. So that's why it's really not an accurate measure. So perhaps maybe inflation expectations might be lower than what is being shown by the current number.
And also, if inflationary expectations become unanchored, it might lead consumers to change their habits right now, which might cause current inflation to become much higher than the committee might think is reasonable, necessary.
Okay, thank you.
So I have a couple questions on the household sector. Oh, sorry, actually, were you going next? Yeah. Okay, sorry. So one thing you mentioned I was interested in, I think it was
Sandra
Pianalto, that consumers at the moment are only spending on necessities. I'm wondering how you know that. What kind of data do we have that we can tell that they're spending on necessities and not, just less on all parts of their portfolio of spending?
Mm-hmm. Well, the data we looked at was retail sales, and we have seen that mainly it's we have not seen, for example, auto sales going up, or products that you would think that consumers would usually spend on in good times. But
there's also the national and income product accounts. This is one of the indicators we looked at. So looking at the monthly personal income and outlays, we looked at what was it where's the money going? And it just shows that discretionary spending still remains not at levels.
And also the high savings rate leads us to believe that people are saving rate leads us to believe that people are repairing their balance sheet and not spending on doing discretionary spending.
Repairing their balance sheets mainly because of the very high debt that they took on during the past couple of years.
That actually leads to my second question, which was about the saving rate. So as you note, it's very high. How much of that do you think is a structural change in where households want their saving rate to be, and how much is just an effect, a more cyclical effect?
So, I mean, that's a very good question. I think one that we're still trying to really find out exactly what percent of that is really a permanent change to the saving rate. I mean, yes, it is at a historical high. It's currently around 5 to 6%.
5 to 6%.
But to what degree? It's quite difficult to really know exactly.
What we have seen lately is it was a really huge decline in net household worth, and a lot of analysts say that the higher saving rate kind of the households want to make up for the loss in household net worth, and that would be one explanation for.
One way to perhaps maybe look at it is to see when it's this permanent, how permanent is this change to the saving rate? Is perhaps we could begin to look at what is happening to the labor market. To what degree are structural changes really impacting the labor market? And since it is really the labor market that is directly impacting households. So to the degree that we see a higher structural changes in the labor market, which is we show the graph on job openings compared to unemployment. Maybe this is suggestive that there is some there have been increases in structural changes in the labor market. So this is suggestive that yes, maybe these changes to the saving rate will be a little bit more prolonged than what we would expect.
And then just changing gears a bit, so I imagine this was a pretty interesting time to be doing this for you because there's been so much scrutiny of the Fed. One of the more interesting suggestions I've seen recently in the press is that maybe we should just return to a gold standard. And I'm wondering what your views are of the gold standard and whether you think there's any merit in that proposal.
Not good. So what is the problem with the gold standard?
One of the main problems with the gold standard, when we were on a gold standard, output was rising at a much faster rate than the supply of gold was rising at, which would cause prices to fall, and deflation is very destructive to an economy because real debt burdens become greater and consumers have an incentive to delay consumption, which lowers output even further.
And it ties the hands of policymakers into how they can address weaknesses in the economy. So currently we see that we need as much as we can to stimulate the sluggish economy. So going on a gold standard, I just don't see the logic behind such rationale.
Thank you.
Let me jump back to the labor market. What data would you look for to suggest that there's been an increase in structural unemployment?
Okay, so one of the, go ahead.
You can look at the beverage curve, which is what we showed, the job openings, high job openings, and the unemployment rate. Since if the unemployment rate is high, it should mean that possible.
These job vacancies are being filled.
Right.
But currently, what we see right now is that job vacancies have been rising, and yet unemployment remains stuck at 9.6%. So this is suggestive that yes, there perhaps might be some structural changes in the labor markets. With that being said, it's always hard to really get a true, accurate, exact measure of what are the structural changes.
I think we said that. No, there was something from the Boston, 1.6%.
We've been talking a lot about QE2, and basically one of the outcomes, right, is if you lower the rate at which firms can borrow, it should lead to more capital investment. But if you look at numbers of cash on hand with firms, it's very high. So if they already have the money, why do they need to borrow, and explain to me how that might lead to greater capital investment?
So the question is, how will it lead to higher capital,
So,
or why aren't we seeing that?
Yeah, why aren't we seeing that? Even though the rates are already low and they have all this cash on hand, how is lowering these rates going to lead to more investment?
So there's a lot of uncertainty, and when we speak about uncertainty, we're talking about the new regulatory framework. Risk currently abroad from Europe, where we see global capital markets are becoming increasingly interconnected. So any risks in any other part of the globe can easily trickle into the U.S. economy. Other risks.
Well, as my colleague mentioned, the financial markets today are more interconnected. So commercial banks in the U.S. are exposed to debts in Europe. So if let's say there are debt problems in Euro, their balance sheets are affected, and therefore that's one of the primary reasons why they're not lending, and in the hope that if we do decrease rates even further, that would probably.
So it's just maintaining a cushion for these risks, for potential risk. And I might also add that commercial real estate still remains another risk, which is the one I was trying to think of. We're still trying to see exactly what's going to happen to commercial real estate. So in terms of the banks, and explaining why they're holding on to this money instead of lending it out, we just argue that it's these additional risks in the economy, that it's just this uncertainty, that's why they're holding on to this.
And also private firms holding on to revenue gain domestically or abroad also reflects the uncertainty on the consumption side of the house, whether they are uncertain that their product will create that demand for future consumption, has always led to that strategy of holding on revenue, paying dividends, rather than investing in capital projects and hiring people. So that could be also a cause of that.
One quick point I'll make about just also why they're not lending is also demand. It's also a demand issue. We're seeing that demand is also not where we would expect it to be given the current interest rate environment. Just a quick point. And an important one because demand is obvious.
Let me put on my college professor's hat now. Now that you've gone through the College Fed Challenge, what's the most important thing you've learned?
How the central bank operates and how difficult it is to operate in.
How difficult it is to communicate its policy.
Also, how to put together a good presentation and prepare for Q&A. But no, definitely, it's to me the most rewarding aspect is really just. This is my second time competing, and I always come back because there's always so much more to learn. Just learning about monetary policy and just what policymakers deal with on a regular basis. I find it fascinating, so that's one of the reasons.
And also in reading the minutes of what happens here, the diversity of views and people that you have also, makes you wonder, how do they really come to a conclusion, knowing that there are divergent views and people have different interests and different views. So that was an interesting part for me to learn.
And I guess also because as a consumer, you want to know in much better sense what a central bank is doing, because you would make decisions based on what the central bank does. So that does help us too.
Yep.
The list might get quite long, but going from theory to practices and these things, it's all fascinating.
And also, working as a team is very important because once we all get a job, we're likely to have to collaborate with other coworkers, and so learning to have constructive teamwork was a skill I learned.
Mm-hmm. Definitely keeping up with latest news, keeping up with latest data. It's fascinating to me that I'm looking at the same data that really everybody else here who makes these decisions looks at, and we're just analyzing. We're doing practically, this is the almost same thing.
Okay, during the presentation, if my notes are right, one of you mentioned the possibility of raising the Fed's inflation target so that we could lower the real interest rates. Is that something the group would generally endorse, setting the Fed's inflation target depending on the state of the economy?
No, this is not something that would normally be even brought up, and there are risks associated with this policy action, because you could perhaps cause an anchoring of inflationary expectations. And as my colleague here has said in his speech, is just that this has been one of the great achievements of the central bank in the past 20 years, is anchoring inflationary expectations. Correct. But we continue to add to this.
Okay, if we're going to anchor it, where should we anchor it?
So go ahead.
There is an implicit target that the committee wants it to be around 1.5 to 2%.
And why 2%? So 2% is because currently available price measures tend to be upwardly biased due to different reasons. There's the inability to accurately account for the introduction of new goods and services, quality changes, things of that matter. So these estimates, there have been estimates by the Boston Commission in '96 that roughly in the CPI are somewhere around 1% or something, roughly 1 to 1.5%.
Underestimates.
And the preferred measure of the central bank, which is the PCE price index, perhaps these biases are lower, but nonetheless, that's why it's assumed that 2% would be sort of like a good inflation target. So
Additionally, 2% gives you a buffer zone from deflation, because deflation is so disastrous to an economy that we have some room to work with in case.
And we have the tools to fight inflation, but yet not a whole lot of experience or tools to fight deflation. So that will be another reason to keep it at that level.
Thank you.
26 seconds.
Okay, we'll keep at it. Okay.
I'll ask a quick one. You up there, you had the LIBOR OIS spread. Can you tell me why that's a good indicator of financial stress?
Because that's the rate that banks offer to to lend to each other in the interbank lending market. And since it's a uncollateralized loan, it just gives a sense of what confidence does a bank have on its counterparty, the rate at which it would want to lend on a short-term basis.
Okay.
Thank you.